Yes.
Okay, so we got a very, very interesting situation here. Um, we've been following the 2 year and the 10 year. Today, they went down like 8%. And the pattern we've been following is as the 2 year and 10 year go up, the Fed has to raise interest rates accordingly. So the 2 year is what we're watching the most. And this is like a drastic drop. And you can see how big that drop is in one day. And that's because we have some volatility in the financial sector now. There's a couple banks um, that are going down a lot because of liquidity problems. Um, and in general, whenever banks are in the business of borrowing money short term and lending long term, and when you lend money, you got to have collateral. You got to put something down as collateral for borrowing money. For instance, if you get a mortgage, you have a house, and you have that house. If you don't make your payments, they take the house. And what happened today and this past week is there's a bank called Silicon Valley Bank, and they let's see, let me get this. There it is. Uh, Silicon Valley Bank. They used startups um, shares as collateral, and the IPOs aren't actually coming through these days because of bad market conditions. So they had some problems raising capital, and um, FDIC basically took over the bank, and it went down 70-80%. So the whole banking sector went down, and because of all this happening, um, there's a rush to safe investments. And whenever there's people going after things that are safe, that makes the yield go down. So you can see the yield going down 8% in like a day or two. So that is pretty unprecedented. And let me see. So what we see right now is all the bank stocks are taking a hit, and there are some bank stocks. We're going to go over this one just for fun. Um, First Republic Bank, it's down 24% today. Let's look at, if a stock is selling off, look, it's been going down for a while, but it's being lumped in with this Silicon Valley Bank. Let's look at where this stock was during the pandemic, right where it is now, basically. It's trading below where it was at the pandemic. And right here in 2018, and there's a lot of support right here at this $79 level. But I think it's very fascinating that whenever one bank has problems, basically there was a run on the bank. And when you have a run on the bank, a bank, any bank, this could happen to any bank. Um, if you have people taking their deposits out because they're afraid they're not going to get it back, it just magnifies itself because everyone's taking their money out. Then this bank, what it had to do was, no, first Silicon Valley Bank, what they had to do was sell some of their liquid assets, which were treasuries. And the treasuries, basically, you assume that you can hold those to maturity, but they had this because the interest rates are going up, the value of the underlying bond goes down. So they had to sell it at a loss, and now there's like a liquidity crisis for this company, this bank. And the big picture for the stock market is um, one of the look right here. Jay Powell suddenly has another problem, and the problem is financial market stability. That's one of his. Price stability is number one concern for the Fed, and financial market stability is up there too. So, in all this problems with the bank was caused by rising interest rates because they didn't the entrepreneurs that are borrowing money didn't have a market for their IPOs, and so let's look at this is a crisis in the making today. And so whenever I see something like this happening, you try to look at see if there's any babies thrown out with the bathwater, they say. So if there's any good stocks that aren't affected by this, and that could be going down a lot. This has all the recipes, all the ingredients for a market sell-off. Because just think.
Well, to begin with, that SVB is an investment bank, right? The rest of the big bank are commercial banks, so they are two different things.
Right.
Investment bank go down, but commercial bank are really strong in balance. I don't think it's a money run off by default. There are two separate different banking systems there.
Right. So yeah, this bank and a couple other banks. There's another bank called SI. Let's look at SI. The Silvergate Capital. I mean, these banks are lending money to people to buy crypto, and this went down 90% this week too. So yeah, every bank has a different business model, but in the crash, in the great financial crisis of 2008 and 2009, there were rules set in place that in order to loan money for mortgages, you got to have like higher criteria, you got to have more money down. So the big banks are following these rules, and I'm not sure exactly, if these companies were following those same rules, or how did they get themselves into this situation? But there's a crisis right now. This could be the beginning of like a 20% drop in the stock market, because if people are, people the stock market in general are afraid, that the stock market's going down, and you have all these ingredients, like you have uncertainty with rising interest rates, you have uncertainty with banks collapsing, and you have a parallel to the great financial crisis where you had Lehman Brothers go out of business. And how do you know the ramifications of that until you find all the counterparty risks, and so that makes for our interest rate situation, it's going to be real hard for the Fed to raise interest rates longer and higher, because we have risk in the financial markets right now. So normally that'd be good for stocks. It would be great that there's more certainty that they're not going to raise interest rates as much. But the problem right now is that all the premium, if you have problems like this, all the premium that's paid for stocks, kind of goes out of the market, and then you go to bare bone valuations for the S&P and for the stocks we're watching. So this has some ingredients to, uncertainty and to, past stock market crashes. So let's watch this and see what happens. Does anyone have any comments on this? Any ideas of what's going on?
I think it's an oversold based on individual investment bank are taking risk. It's not the big picture of banking system at all. So I'm going to buy when they go down to a certain time. Right.
Hey, so we're not. Go ahead.
I was going to say, my understanding of the Silicon Valley Bank is that they had put a lot of their deposits, purchased a lot of long-dated, like government bonds that lost value as rates went up. Mm-hmm. And then the venture capital companies that they had been making with them had less access to capital and they were starting to withdraw money, as they have these long-term assets and immediate-term withdrawals, and they had to start selling, and they started selling at a loss, and they tried to raise money, and then they tried to sell themselves, but then people were starting to lose faith, and so the companies that did still have a lot of money with them started withdrawing massively, and so it was a kind of a run on the bank that they did not have the assets they had lost value on the open market, and they couldn't pay back depositors, and then
Right.
people lost faith in the bank.
Right. There's a very famous venture capitalist, Peter Thiel, that recommended. He runs some kind of venture capital. He said, take your money out of this bank, and so that started the a run, and so the government actually seized that bank, and now all the banks are going down regardless of whether they're involved in this or not. So J.P. Morgan, which is the largest, it's down a lot, and Bank of America and all the regional banks are going down with this. So for me, I'm looking at this, and you have to say, well, let's look at all the stocks that we're following, and how does this affect the stocks? For the most part, most of the stocks we're following have PEG ratios of greater than 1, and if there is a sell-off in the stock market, most of them will go down to their PEG ratio of 1 or lower. But most of them aren't affected by this isolated couple banks that are failing, because the stocks we're following are capitalized pretty good, and they don't need to borrow money. But when you have uncertainty like this in the stock market, and people lose confidence in the banks or whatever, then you don't have a premium paid for stocks anymore. So and then you lose that bubble, or that premium you pay for stocks that could have the high PE ratio stocks, etc. It could turn into a crisis, or it could be a second great financial crisis starting. We don't know until a couple weeks from now, when everything is understood about how all these banks are handling this. We won't know, but we had a couple of things happen today. You can see that there's U.S. jobs created in February, unemployment rises. Okay, so we have in the government, we have these reports that come out, like in January or every month, for jobs and retail sales, etc. And a month later, they revise them. So they were revised today, and basically the economy isn't as strong as what the report said last month. So all this is combining into the Fed is kind of, they can't really raise rates more than maybe 25 basis points next time. So they might even start cutting if this turns into some kind of great financial crisis crash or something. So anyways, this is something it just sounds like something that can turn into a great financial crisis number 2. Because we have all this, I think the big picture is we had a lot of liquidity from all these crazy interest rates for 0 for 10 years. And we had the pandemic money coming in, and we had inflation. All this has combination of stocks, correcting. And so what I did today was I put together a little, if we do have a correction where it goes down, things to do and things not to do. So I thought that'd be interesting. So we'll go over that a little bit later on. Let's see. Let's look at some more articles from today. Okay, so that's good. Let's go over what's going down in market movers. I bet you all the banks are going to go down a lot. Look, there it is. Look at all the banks in the top decliners. 23%. Signature Bank, First Republic Bank, Charles Schwab, Truist Financial. Wow. I guess some of these stocks, like the Charles Schwab, they started tiptoeing into crypto. It's turning out, it seems like crypto is becoming like a big musical chairs. You know, I played musical chairs when I was a kid, and then you walk around and there's always someone that's left without a seat, and that's what seems like is happening right now with this crypto. There's crypto firms failing right and left, and before you know it, people lose confidence in something that doesn't have any value, and the worth of crypto is only what the greater bull is paying until until there's no seats left, and then that person's stuck with all the worthless crypto.
Surprisingly, JP Morgan is up.
What's up?
Surprisingly,
JP Morgan.
Yeah.
Yeah, so I think JP Morgan, they sold off a lot the other day because of this
What
problem.
about Bank of America?
Let's look at Bank of America. They sold both Bank of America and JP Morgan sold off yesterday. It could be a rebound. There's analysts probably coming out now saying this bank has no problem. It isn't affected. Look how JP Morgan sold off. It sold off. Let's look at.
Yeah, but it's up today indicating that whatever happened to that bank is not affecting on the rest of the big bank, right?
It went down 8% from yesterday until today. Okay, so it went down 8%. When stocks are going, they're crashing like that, they're correcting. You have to look at past levels of support, and sometimes when there's a sell-off, like the Great Financial Crisis, people don't even look at what it's really worth. So let's look at, if JP Morgan sells off more, it's up a little bit now, but if it sells off, you have to look at the past levels where there was support. Like this is the 2020 COVID correction. It went down to $79 a share. Okay, so let's keep that in our mind. $79. We have like right here, $98. Right here we have $103 right there. Okay, so whenever
Can you look at the today event, because this is related to today event, right? So one day.
let me see. Oh, do you want to look at one day?
Yeah, because the bank failure may affecting it. That's the question.
I think JP Morgan has their act together. They're not gonna take crypto for collateral. They're really smart. They've been around for 120 years, right? So this is just whenever something bad happens in a sector, all stocks go down with it. I wouldn't be surprised if this goes down more just on the news of a bank, being taken over by regulators.
Similarly, Bank of America is also up today.
Let's
not
compare,
changing, not go down.
Let's compare it to bank. This issue with this bank has nothing to do with these two banks. Yeah. So, but they will go down in sympathy. It's up a little bit today. Bank of America isn't. Okay, so you can see these banks, they're like in lockstep. And Bank of America has gone down more than JP Morgan, in the past. This is just one day. Let's go out to 1 year. Okay, the same kind of thing. The Bank of America is doing worse than JP Morgan recently. Bank of America is the purple one. So you can see they all trade together. But, for me, I'm already invested in JP Morgan. I'm sure that they have a lot of reserves. I mean, they're forced. The big banks are forced as the fall of these regulations where you have to have a lot of money in reserves. And this is just an example of going down with the news and how this, I don't think that's affecting these stocks. But if you don't have any of these stocks, let's look at Bank of America. If you don't have any of these stocks, and you're interested in dollar costing into these sectors, you have to look at, let's go back, and this is the COVID lows, where Bank of America is down to here. We don't have numbers for some reason. I don't know why the when you're okay. So we have a lot of support right here. This is July of last year. July of last year, it went down to that same level like right now. So there's a lot of support where it's at right now, and there's also support right here. But if there was a major crisis where all the banks go down, you have to look at right here and right here are the next levels that it could correct to. So this is what you do during market corrections, because it doesn't matter what the stock is worth. It's going to go down, just because there's forced selling. Okay, so that's interesting that all the banks are going down today. 23%, 21%. I bet you the Signature Bank, First Republic Bank. Yeah, I don't know anything about banks, really. I don't. And Louis Navigator, he's like a bank analyst. He's an ex-bank analyst. He says no one can understand these banks because they could manipulate numbers, and it's really hard to analyze. It's not like other stocks. You have to borrow money. They have to whenever you have debt in a company, that's usually a bad thing. But the banks have to have debt, and it's just a different way to run a business that we can't really understand. So look, they're all going down. Let's look at what's going up. Cigna, Intel, JP Morgan, AbbVie, conservative companies. These are companies that pay dividends, that have been doing good recently in the stock market. I don't know about Intel. I don't know why that's up, but in Cigna, it's a insurance company. So Valero is oil. All right, so let's look at the NASDAQ, what's going up and down. DocuSign, this is a poster child for overvalued stocks, and we've been saying that since it was in the 130s. These are all high PE stocks. Every one of these, whenever there's a stock market that is volatile and correcting, people are scared. People get out of stocks with high PE ratios and move towards stocks that are lower PE ratios and more conservative. You can see drug stocks. Gilead's a drug stock. Why is Tesla's up today? These are stocks that pay dividends and or drug stocks that are more consistent. We have, all right, so let's look at what the Dow. Okay, these are all stocks that are higher PE ratios. And these are stocks that are paying dividends and or more conservative drug stocks. And Procter & Gamble's house, they sell items that are consumer staples that are very consistent and pay a dividend. And so, we have a really dicey situation now. So what I did was I put together a checklist of what to do, whenever you have this kind of sell-off. And I didn't get a chance to do it yet today, but there are ETFs. Whenever there's sell-offs, it's very important to realize that the spreads for these stocks and indexes are not in your favor. If you want to get out right now, you get a really bad price if you have to sell. Number one, it's going down a lot. Number two, they're going to rip you off on the bid and ask. and because there's not as many buyers as there are sellers. All right. Okay. Is there any questions about any of this? Any comments? Right.
It may be just a coincidence, but stock probably goes so bad that our voice 401k system actually unable to lock it in.
Really? Oh, well, I can't explain that. Yeah, but I guess whenever there's volatility in the stock market, there's a increase in trading. So, and because of that, that's really good for the trading companies. I'm surprised Charles Schwab is down today because that'll increase the number of trades and activity on their platforms. But you also have problems where increased activity causes stability problems for the major, companies in trading and things like that.
That's why they're also lending money.
Yeah.
So they are investment bank also.
I didn't realize that.
You can borrow more money to invest.
Oh yeah, right. Yeah, you're right. You're right. Right. So that was it. We usually don't spend a whole lot of time in current events like that, but this was just this is a huge story, and it takes over anything valuation wise in the stock market. But let's look at the S&P, the S&P 500, and see where it's at now. It's down 2%. Full screen. Okay. We're going to take Bank of America off of that. Okay. Okay, so right now, indicators, moving average. We'll just do the 200-day moving average right now. We'll make it red. Okay, you can see that we had a time here where the 200-day moving average, we were bouncing off of that, but today we went through that. And the hope is that, the 200-day moving average for the index and most stocks stay above that, and then we start trending upwards in the 200-day moving average. If that happens, that's positive momentum for the stock market, but we obviously went down way below that today. So when we look at, if we have a sell-off, different levels, the S&P could go to. We have this level here at 381. We have, this is the low from last October, around 356. So those are key levels right here and here. And if we have a sell past that, we have to look at here, here, and that this is the COVID lows. Go down here in 222. That's like a lot more than where we're at now. So, all right, so I'm going to go into my talking points. Okay, March is usually a good month. We have, next week we have more inflation reports on the 14th and 15th. And then we have triple witching on the 17th. So that'll add volatility. And then we have end of quarter window dressing. So even though March is typically a good month, when we have a crisis like banks going under or taken over by the FDIC, that is, none of this works. None of this forecasting what's going to work. Nothing seasonal works. Everything goes down with the stock market. So that's like a trump. If you ever play cards, that trumps everything. A bank's going out of business. That is pretty big. All right, so let's look at our talking points. The S&P is down since last week. The interesting thing that I brought up the first thing was, as of this morning, or last night it was down 6%, the 2-year and 10-year, but now they went down 8% from that point. So that that down 8% and down 4%. This is the important thing. If the 2-year goes down a lot, that means the Fed really can't raise rates a whole lot more than where they're at now. So they'll probably raise it 25 basis points more. But what's happening? The reason why these are down is there's a demand for treasuries. So whenever people have, when the stock market's going down, people are gravitating towards buying safe things like treasuries. This is the safest thing you can buy in the United States right now. And everything else is going down. People buy more of these and the yield goes down. So that is interesting. So the economic numbers that came out today, that made this go down because the economy is not as good as they said it was in January. And because there's a run on the banks and possible interest rate rises, due to the interest rate rises, that all kind of formulates to, the rates not going up as much as the Fed was saying earlier this week. So the Fed was talking this week at Congress, and that kind of made everyone worried that they're going to raise rates a lot for longer. But all this that's happening today and yesterday with the banking sector, that kind of offsets that. And that's usually good for stocks.
Well, actually, there are two things, right? First of all, the number of unemployment, the number of new hiring is still higher than expected. Second of all, we cannot say that run-on banks when you have regional bank fail. It's not national bank. So I don't think the Fed will change the direction at all. And isn't that true that he mentioned a day or two ago that he on course to get a bigger raise?
What was the last thing you said there?
Isn't it true that the Fed actually announced that they're going to increase the rate big time
Right.
a day or two ago? So that wouldn't change when you only have a regional bank fails.
That's, well, we don't know.
We don't know because unless you got a national bank run off, then regional bank fail all the time.
That was a top 20 bank. The Silicon Valley Bank in deposits, maybe top 10 or top 20. So that's pretty big.
They are investment banks.
Yeah, I'm not sure. I don't know the difference between the two. I really don't know anything about this. But the articles on the front page are Treasury carefully watching crisis at a few banks, right? So that's one thing. So she thinks that
focus on a few banks, even in a quote.
Right. So, and all right. So we're not banking analysts here, but the reports on TV say that the Fed was very, very hawkish. They said they're going to raise rates longer for higher. He says we're going to have higher interest rates than the market expects. And as soon as that happened, that kind of caused some of these banks to do what they're doing now. So, let me see. What was our talking points here? All right. So whether it's a crisis or not, it doesn't affect the big banks other than the premium that you pay for them. Maybe there's less for premium, but it's perceived by the market that there's some kind of it's like First Republic Bank, even though there isn't, if it's fundamentally sound, if there's a run on other banks similar to that, you can't prevent a run on a bank. And then what if people start taking money out of that bank, and then they have to do the same thing, sell their treasuries for a discount? I don't know. It sounds like a crisis to me. But what I'll explain a little bit later is, you got to be ready for crises and crises, and you have to be looking at, does this affect the 1 year, 5 year, 10 year timeline of the investments I'm in? Right. Okay, so here's a little picture on inflation. This is the inflation rate. I mean, it peaked around July of last year, around 8.5%, and it's been steadily going down. So that's a good sign. The dollar is actually going up recently, so we'll get a picture of that. You can see that it was in a downtrend, which is really good for stocks that do business overseas, but it's starting to go back up again. So this was a tailwind for a lot of the big companies like Apple, Google, GE, companies that do business overseas, but that's turning just a little bit. All right, so we already looked at the ETF, the sectors, and okay, we're oversold. We're at the bottom. We've been steadily going up this new channel, and we saw it today that we broke through that. We're down to here. So the interesting thing about that is, we're approaching what's called the line on the internet these days. This line right here, see this downward trend? It is, the stock market is basically gravitating towards that. We're basically at that bottom part of that line right now. Let's hope we're not dragged into going down and revisiting these this downward channel here. We were doing so well. We have all this momentum here, more momentum than we've ever had. And if this makes us break this channel, we're going to end up probably going down to here. We're going to go zigzag down to here. So we're oversold. That doesn't mean we can't be more oversold in a crisis. So we've been holding around a 200-day moving average. Let's zoom in on that a little bit. Okay, this was as of last night. The 200-day moving average is right here, this purple line, and we went through it today, and we're down to this line. So let's hope we this uptrend, somehow through all this. I know that not raising interest rates as much, or if we have some kind of news from the Fed where they're going to support the market, in this maybe the takeover of some of the troubled banks. I don't know, but we're at a period right now. This is a turning point. We had some momentum going up, and we don't have support here. We're going to go down here. That's not so good. All right, let's look at next talking point. Okay, we always review this. Dan Niles, he's like a super smart person. He's been saying treasuries are the most, the safest thing to buy. That was what he recommended 4 weeks ago. And he said the fair value of the S&P is 3,000. Let's look at that on a chart with the S&P. Let's see where the S&P is here. Okay, let's look at where 3,000 is. 3,000, no. $3,000 will take us down to right here. Wow. It's like 20% lower right now.
What do you mean by 3,000? Sorry.
Dan Niles, he said that this is the S&P. Right now, if you look at the SPY,
yeah,
it's basically the price is 1/10 of the actual S&P 500.
Okay. Mm-hmm.
So if you add up all the stocks in the S&P, it adds up to 3,850, right? And 1/10 of that is what you pay for this SPY. So let's look at, so if he thinks 3,000 calculation. He thinks 3,000, 3,53850. That's 23% lower than we're at now. So he said there's a very good chance that we could go back to like a 20% correction. So let's keep our eyes on this. So he said there's 50% chance we're just bouncing around, for the next year, because there's earnings that are being earnings estimates that are going down, and there's not a whole lot of catalysts for the stock market now, along with the interest rates going up. Okay, so let's look at
why not go down to 250 pre-COVID? I mean, during COVID, why 3,000?
Let's look at it. This is COVID lows. This is 200.
Yeah.
We could, and if we end up in a market sell-off, our levels of support are right here. This COVID lows. This is like probably the lowest it'll go, and then we have right here, which is 32. Right here. This is the lows of last October.
So when we are in uncontrollable environment, we are 250 or 200. We are in very much controlled environment right now. We just the Fed decision, so it cannot go down that much, right? Even 3,000.
Well, I think the hard part about all this is you're fighting the Fed when you're expecting the stock market to go up, while the interest rates are going up. The stock market's either going to go sideways or down. It seems. That's what it seems like to me. And all stocks gravitate towards their fair value or their mean, their average over time. So those are the things we got to keep in mind. And the S&P is, let's say, a PE of 18 now, and its average over time is like 14. So we have to know that over time things go back to their averages. So for me, I'm holding. I'll explain to you reasons, to sell and why you should not sell, etc. Okay, but right now we have fear in the market. Okay, we've been tracking this. It was greed, neutral. Now we have fear. After today, it's probably a lot worse than that. It's probably extreme fear. Let's look. It is. In one day, we went from fear to extreme fear. You can see that market momentum, we're losing market momentum. We have the stock price strength. We have all this momentum up to here, and now, that's going down a little bit. Stock breadth. This is the amount of stocks going up versus going down, and we had some momentum, and now we're losing that. Put to call options. So people are buying more puts than calls now. And when the market's going down and up a lot, that's people get afraid, and that's extreme fear. Okay, so we have overnight we have extreme fear in the stock market. So this is an example of the VIX is probably going up too. It was only 22 yesterday, but now it's, I'm sure, let me see. Probably going up to 25 today. 20% in a day. Can you believe that? Went up to 27. Okay, so people are starting to get fearful. And when it gets up to 30, that's like, sell-off territory. And that's pretty big. Okay, so now we're up to fear, and then pretty soon we're going to be at panic and crash. All right, so the stock market goes down when the VIX goes up usually. This is the best quote I can find for this week. This guy, this Whaley guy, made that Whaley thrust indicator we've been following. The momentum. If the momentum is really good, then it usually helps the stock market up over a period of 1 or 2 years. But this guy said, major problem for 2023 equity market is if you are bullish and the market goes down, you have to live with fighting the most hawkish Fed of this generation. If you are cautious, cash, and the market goes up, you earn 5% and live to fight another day. So this goes back to Dan Niles. At the beginning of this year, he was saying, well, the best things right now are treasuries, which paid 5%, and cash, and as the top two things you can do for this environment. So I thought that was really interesting. Okay, we already talked about these things. We had two banks that that basically going out of business and being taken over by the FDIC. And so I put some lessons learned. Basically, stay away from crypto or any kind of investment involving crypto, like this Silvergate lent money for crypto. And crypto is like musical chairs, and it's basically whoever is willing to pay. It's whoever's the greatest fool to pay more than what you paid. And so another thing we learned is when the stock market is correcting due to a company failure or a market crisis, all this stochastic stuff we're following, and the PE ratio, that all just doesn't work. When the market goes down, it basically looks at these. The stocks just go down regardless of fundamentals or stochastics or anything else. Stochastics only work whenever you have a controlled environment, like we've had for past 10 years or so. Stock market's been going up, and we can predict when it's oversold and overbought. But right now, you can throw all that out the window, and the stocks will basically correct to their fair values or less. So whenever one stock in the sector goes down, all stocks go down in sympathy in that sector. So I mentioned here, this could lead to a financial crisis. When you see a bug in your house, there could be more around the corner. And it's the same thing with these banks. If this happened to two banks, how do you know what other banks are involved in this? And so that could lead to a financial crisis. We don't know. But big banks like J.P. Morgan, Wells Fargo, and Bank of America, they're probably not as affected by this because they have to follow the rules set out in the crisis in 2008. So I think they're well capitalized, and they're not going to have those problems. All right, so this goes back to what Matthew was saying about the Silicon Valley Bank. There was they had a lot of bonds that matured in several years from now, and whenever the interest rates go up, the value of those assets go down, and they were forced to liquidate, and they had to take a loss on those bonds. So then they're trying to raise capital, and then people are trying to withdraw their money, and they basically said, that's it, FDIC is taking over. So let me see. That was really interesting. So it's really hard to invest in banks. Really, we don't understand them very well, and it's beyond what we could understand, and they manipulate their numbers. So even the bank analysts don't understand them very well. I wrote some interesting things I found on Twitter. If you're not on Twitter yet, it's a really good idea to start following some of these really smart financial people. This adage, I've tried to find who said this first. It's not time in the market, it's timing. No, it's not timing the market, it's time in the market. I know Peter Lynch said that, a couple other people said that, but when it comes time to stock market crashing and correcting, you got to realize whenever you try to sell out of something, it's hard to time when to get back in and what to buy when you get back in. So this is a little chart that says, if you're out, if you're fully invested, you over, you see, what is this? Between 2003 and 2022, fully invested 10%. But if you miss the best 10 days, you only have a 5% return. And you miss the best 20 days, your return goes back to 3%. So, the ability for the average person to time this it's really hard to do. If you miss the best 60 days, you have a negative return. So, just keep that in mind. I always look at this whenever I'm like, when there's a bad time. All this, bad news this week. There's been some really good news from Goldman Sachs. They usually don't say a whole lot about Apple, but they've had like a neutral to negative on them for a long time. But they said they have a 32% upside in Apple because the market is underestimating the brand's ecosystem, and they have like a 99% satisfaction, in their products and recurring users and services, innovation. And that should protect their stock, and they're decently priced now, they're saying. Well, I just did a quick check on Apple's earnings, and they're projected to grow around 9% the next 2 years on average, and they pay a 1% dividend, so that's a 10% total return, and their PE ratio is 26 right now. That's pretty high. That is really high for the stock market. We've been saying for 2 years that Apple's super pricey. Its PEG ratio is 3, around 2.8. That's like 3 times overvalued. So they're only growing at 9%, and you're paying 27 PE. So you divide that 26 by 9%, and you get how many times they're overvalued. I'm not sure exactly. Goldman Sachs thinks you got to pay a premium 3 times of their growth rate because that's consistent earnings. And so here's their numbers. The PEG ratio is 2.55. That kind of matches our numbers. And the profit margin is double what we normally like 13 or 12. And the return on equity is out of the park. It's like 147. We like 14 or greater. And they have the dividend. So but before the last 2 weeks ago or a month ago, they were only growing at 7%, when we did that calculation right here. Now it seems like they're growing a little bit more. So, but Apple's going to go down with the market because if there's a sell-off. And so we have to keep track of these, the fair values of the stock. So the fair value is 1/3 really of where it's at right now. So that brings it down to like $65 a share. In a real true sell-off, it might go down to $65 a share. But right now, it's because of its user base, 1 billion users currently, and a lot of them pay service fees. That helps the stock consistency. I know we're almost at the end of our talk here. Bear markets typically end, this is a guy from Twitter, 14 months after the final Fed rate hike. So this guy is kind of insinuating we're going to be, going down for the next year or so. He said in 2024, that's the end of this bear market. Let's hope that downward line isn't going to take us lower until 2024. So, but there's just as many positive things on Twitter as negative. I just thought it'd be interesting to see this, guys. Yeah, one more topic to cover. Berkshire Hathaway is buying more and more of this Occidental Petroleum, and he's bought 22% of the company. And he actually initially gave some finance to the company for its purchase of, I think it's Anadarko Petroleum. and then he got these warrants. Now he's starting to accumulate a huge portion of this company. And so lesson learned from this is it might be a stock to look into, because if he's amassing this big position, and he has the resources, Warren Buffett's company, eventually taken over the company. So I like to look at news stories like this and keep an eye on that stock. And whenever we do have a sell-off of like, and Occidental goes down 50%, half off, then you can say, okay, I remember that was a Warren Buffett stock, and he's going to be buying more of it, and there's a good investor that's keeping the price stable at 25%. If he owns 25% of the company, he's not going to be selling it. So that makes price stability in the stock. And so I like to just bookmark this. You can't buy it on this news. You got to bookmark it in your mind and say, all right, when it goes on sale, let's see if it makes sense. What I did was I looked at, why would he like this stock? And we're looking at the same numbers, I think. The return on equity is 58. That's really good. And the minimum we like for return on equity is like 13. Profit margin is 3 times what we like. It's 12. 12 is our minimum, and this is 36. And the PE ratio is low. He likes, Warren Buffett likes buying really low PE ratio stocks. He bought Hewlett Packard, HPE, last year, and it was a PE of like 5 or 6. And so another thing is, their debt levels, 20 billion versus market cap of 55 billion. So they bought this Anadarko stock, and that put them in debt, but they got some funding from Warren Buffett for that. So they're working off that debt now. That's like their biggest problem. So I didn't see any consistency here in their earnings estimates. I don't think anyone can predict the price of oil. So it wasn't a compelling in a straight line up. That's why I'm like concerned about this. And no one can really know what they're going to earn, because no one knows the price of oil. But that kind of made me pause, and we'll revisit this maybe another time whenever these numbers are going up in a straight line. But this is a kind of stock that I like. I'll wait for it to go back down to here. Warren Buffett bought it, and everyone's excited about it. And then when the market's selling off, you start looking at it down here and know that 25% is owned by the smartest investor of the world. All right, so that's another interesting article. You see. Okay, so I'm gonna breeze through these final ones. Okay, the CFRA says the fair value of Oxy is 15% higher than it's at now, and Morningstar says it's right at its fair value. So, but Warren Buffett's been known to pay a premium for his stocks, so we'll keep our eyes on this. It didn't really make sense to me. As soon as these numbers go up in a straight line, I'm more interested. 2 other pieces of news. White House endorses new Senate TikTok bill. If TikTok is banned in the United States, what companies will benefit from this? Anyone have any ideas? And what companies will be hurt?
Does that help Facebook with Instagram and stuff?
Yes.
Maybe.
Yes, that is a major competitor of Facebook, but it's also a major competitor.
Google, YouTube, right?
Yes, that is a major competitor for YouTube. It's basically the eyes taken away from the YouTube platform. And any companies that will, another one is the smaller advertisers, like what is the example that the company that does the eyewear, and I forget. Okay, smaller advertisers similar to Google. They have these trendy sunglasses you wear, and I'll figure that out. But what companies will it hurt? It might hurt some of the Chinese stocks, because if the government starts cracking down on this Chinese company, what happens to the other companies? Will they make rules where Alibaba can't do business in America? I don't know. But every news article that comes out, you got to say, does that affect my stock. Maybe it might help Microsoft. I'm not sure. But so you got to see. Well, that's really big for Facebook. Actually, that'll give Facebook a huge. They have Reels almost replaced up to, the quality of TikTok now, and that could really help them. Let's look at this little article about the stock market will crash in 60 days. Best-selling author on Lehman collapse warns. Okay, so this is really interesting. This article, this link here, the article says he warns a crash will come in a matter of days. So we have parallels here. We have a collapse of banks, and this guy is saying that within 60 days, we could have a collapse because of this rising interest rate. And we have inflation starting to rage. We have systematic risk in the financial sector. So, so he's saying all these things combine to a possibility of a crash. So we're going to keep our eyes on, this article, what he said in this, and see if that actually comes to pass. And the other thing I wanted to say, it's very important for a crash time like this. This is the last slide. You got to have a playbook for surviving market crashes, and you have to say for every one of the stocks, whenever we're following these stocks here, right here, for any correction in the stock market, any crash, you got to say, how does that affect, these stocks we're following, and the 1 year and the 5 year time frame, and you do that with news stories too. But this is how you survive these times. You have to look at the for ETFs, you have to look at the net asset values, like an SPY. In a market correction, it's going to trade at a discount to its fair value because there's more sellers than buyers. And a lot of times you get really good prices on bond funds and stock funds, because if you keep track of their net asset value, they typically trade at a premium or at their net asset value if it's a liquid ETF. But if you try to sell a stock or an ETF in a crash, you're going to get ripped off, because the bid and the ask are you can run a truck through it, and you're going to get ripped off. So you have to be really sure, if you're selling in a sell-off, what you're selling is, why are you selling it, when to sell it. You have 3 decisions you make: when to sell it, when to get back in, and find something to replace it. Is it better than what you sold? That is really hard. That's why I'm majority holding my portfolio, and because it's really hard to make those decisions. And whenever you have crashes, 10 to 20%, almost every time you look at the major crashes in the stock market, within 2 or 3 months, or 2 or 3 months, they've recovered a good portion of that crash amount. So you have to make sure that you don't get suckered into selling in a bad day. And you have to make sure the quality stocks we're following, they usually trade down to a PEG ratio of 1, their long-term growth rate. And you have to say, well, this is the price you pay for being a long-term holder of a stock. And the other last thing I wanted to say was Microsoft Bing has 100 million active users. I think that's a pretty big story. Google has 1 billion active users daily. That's 1/10 of Google's users. But they had a preview, so maybe there's a little excitement in that. Are they going to stick around? I don't know. But having overnight 1/10 of a share in the global advertising market is pretty darn big for Microsoft, if you ask me.
You use Microsoft Bing a lot, right?
What's that?
You Microsoft Bing a lot.
I never use Microsoft Bing.
You use Yahoo.
I use Yahoo a lot
running
for
Microsoft Bing.
Oh, I didn't know
Microsoft
that,
Bing
really?
running Yahoo search.
I didn't realize that. Wow. That's great to know. But Microsoft looks like that that's a really good story for Microsoft, not good for Google. So Google has to invest more in AI to really come up with a competitive product. Okay, so the other thing is we're getting to a point where fear and capitulation in the stock market. I mean, just overnight we went from fear to like capitulation. And when we get down to this despair, that's whenever people start selling off, and that's just the worst time to do that because then it starts going up. All right, and these are typically good times of the year, the next 3 months. But sorry about this. These are typically good times in a month, but like I said before, whenever there's a stock market crash, the stochastics don't work. This monthly average seasonal patterns don't work. It just and valuations don't work. So all these peg ratios, we're following everything. You gotta like throw that out the window and just look at levels in the stock market and where there's past levels of support. That's it for today. I'm sorry I went over just a little bit. If you have any questions during the week, let me know and I'll try to answer them. All right, have a good weekend, everybody.
Thanks, Greg.
Thanks, Greg.